Today, we're looking at an analysis of DataVault AI, or DVLT, right after they announced that new $7 million deal with MTB Mining.
Right.
And the material does a great job setting up this central paradox. You have this big positive news, a $7 million fee, a 30% royalty on things like gold and copper.
And the winds are ruby, right.
Exactly. But the stock immediately tanks, down over 5%.
And that's the whole story, isn't it? It's this massive validation on one side, and then, well, a pretty brutal market reaction on the other.
So the question is why?
Exactly. The question is why. And, I think we need to figure out which of those stories is actually winning the narrative war right now. So maybe let's just start the critique right there, with how the market is processing all this.
Okay, so a key theme running through this first part is definitely trying to explain that price drop.
Mm-hmm.
The material points to three things. You've got the classic sell the news profit taking.
Sure, standard stuff.
The technicals, with the RSI over 70 suggesting it was, overheated. And then the lingering pressure from short sellers, especially that Wolfpack research report.
And the weakness there, I think, is that by just listing those 3 points one after the other, it kind of treats them as equally important.
Right.
And it fragments the story. It doesn't really give the investor a clear takeaway. We need a much more cohesive idea that really prioritizes which of these skeptical points is dominating the conversation about their RWA validation.
Assets.
The validation moment.
Yes, but if the stock still drops, the analysis really has to get specific about the market's tone. Is this just a garden variety technical correction that was going to happen anyway? Or is it something deeper, like fundamental skepticism about the quality of this validation?
Exactly. So the suggestion is to connect that short seller skepticism directly to the RWA pivot. If this deal is really concrete proof, why is skepticism still winning the day and driving the price?
You have to tackle the bear case head on.
You have to. If you're writing for the long-term believer, you have to acknowledge that the bears are seeing this price drop as proof that the company's claims are empty, despite the $7 million. And that makes the bull case even more urgent to solidify.
So, to make that actionable, instead of having 3 separate bullet points for why the stock dropped, you could reframe that whole section.
How so?
Maybe under a theme like skepticism overrides technical correction. Something that immediately tells the reader which force is stronger right now.
I like that. And building on that, you could analyze the implied risk the market sees in the deal itself. I mean, they're using their Sumerian tech to create these digital twins for an exchange.
Right, the International Elements Exchange.
Is the market pausing because that whole process just sounds too complex? Too, unreliable? Or is it that short sellers are just successfully raising questions about the royalty collection timeline?
Because that 30% royalty is great, but it's slow money.
It's very slow money. So the analysis needs to get sharp. Which risk is scaring investors away right now? Complexity or cash flow timing?
That's a great distinction. If you can pinpoint that, you move from just describing the drop to actually explaining, and maybe even refuting, the reason for it. It becomes predictive.
Yes.
So if the market is really questioning the validation, well, the next logical place to go is the financials. Can they actually execute?
Mm-hmm.
The material does make a strong connection here. It highlights that $7 million is a massive number when you put it right next to their trailing 12-month revenue of only about $6 million.
So this one deal is bigger than their whole last year.
Exactly. Which is why it's positioned as the key validation for that, frankly, very aggressive $200 million revenue target for 2026.
And that's the key, but the weakness for me is in the follow-through on quantifying the risk. The piece says something like, if they can secure 10 to 20 more deals of this size, the target becomes realistic.
Which is true mathematically.
It's mathematically true, but it just glosses over the insane risk in that assumption, especially when you see the cash burn warning mentioned later. It doesn't connect the two forcefully enough.
I completely agree. The monumental scale of what's required from their sales team isn't really stressed. So the suggestion has to be to directly link the company's, pre-profit status and their high burn rate to the execution risk of landing 10 or 20 more of these huge deals.
It's an existential risk.
It is. Investors need to understand the downside if just 1 or 2 of those deals don't happen on time.
We have to give that guidance the scrutiny it deserves. So, for a concrete example, you could explicitly quantify the required speed.
What do you mean?
Well, do the math for the reader. Hitting 200 million means they need to close a new $7 to $8 million deal basically every 2 to 3 weeks for all of 2026.
Wow.
Yeah. When you compare that to closing $6 million in the last 12 months, that's not just growth. That's a full-on exponential leap in sales velocity. It should be framed as a massive, massive challenge.
And we have to be tougher on that cash burn warning, too. It all comes back to dilution risk, which is what's keeping the stock down. A key question is that $7 million collected immediately? Is it cash in the bank?
That's a huge question.
Because if it's paid out over several quarters, or if it's tied to certain milestones, then the risk of stock dilution is still very real. That adds a crucial layer of context.
And building on that, what if we look at the $200 million target from a payment structure perspective? Does the analysis assume all future deals will have big upfront fees like this one?
Or will they have to rely more on the royalties?
Exactly. Because if they start relying more on those 30% royalties, that completely changes the cash flow forecast. It means slower, deferred cash, which puts even more pressure on their burn rate right now.
So that dichotomy is essential. Upfront cash validation versus long-term royalty risk.
Yes. That framing makes the risk assessment so much more powerful. You're basically telling the investor, yes, the contract is real, but the bridge to $200 million is incredibly fragile.
Okay, so let's move to the stock price forecast. The analysis is pretty sharp here in defining the technical levels.
It lays them out clearly.
You have the bearish case, a test of $2.30, and the bullish case, stabilizing above $2.40, and it correctly identifies the $3 resistance wall and the next catalysts, like the launch of that new exchange.
But is the connection between that price action and the catalysts really established? The weakness I see is that the technical analysis is kind of in one bucket, and the future catalysts are in another.
They're separated.
They're separated. Yeah, and because of that, the leap from, say, a dip to 230 all the way up to the analyst targets, which are near $5, it feels almost arbitrary. The predictive flow needs to be strengthened.
I see what you're saying. The technical analysis needs to explain why just holding above 240 is basically meaningless without some new catalyst.
Right.
So the suggestion is to integrate the analysis of that $3 resistance wall with the urgency of the next catalyst. The market needs fundamental news to break through a technical ceiling like that.
Precisely. You have to tell the investor what sustained momentum actually requires. So for the bullish case, clarify that stabilizing above 240 is just playing defense.
It just stops the bleeding.
It just stops the gap from filling down to $2. But sustained momentum, the kind you need to break and hold $3, is completely dependent on the launch of that exchange or another big deal announcement. The price is just going to stagnate until the next data point arrives.
That's a great refinement. And we could make the key takeaway even sharper by making the recommendation contingent on a catalyst watch.
What would that sound like?
Well, instead of just saying the 230 to 240 zone is a high-risk entry point, you structure it like this. The entry point only becomes justified if a secondary catalyst, like proof of payment for the $7 million fee, emerges before the price tests 230.
I like that. That's very actionable. It gives them a defined window.
Exactly.
And maybe one last thought on those analyst targets. Is the link between the RWA story and that $3 consensus target really established? The analysis should probably suggest a sanity check.
A sanity check?
Yeah. Did the analyst $3 target already price in this $7 million deal? Because if it did, if this was already anticipated, then the next major price move depends entirely on the scale of the next partnership, not just this one.
Ah, that's fantastic. That helps investors avoid buying into a target that the market has already priced in. It forces them to think one step ahead.
Exactly.
Okay, so we've covered three pretty substantial areas here. First, to synthesize that market reaction into a single, sharp narrative, basically unifying the reasons for the dip under this banner of fundamental skepticism.
Right.
Second, to get much more aggressive in quantifying the risk of that $200 million guidance by stressing the execution speed and really scrutinizing the immediate cash impact of this deal.
And finally, to strengthen that predictive flow between the technical price action and the absolute need for new catalysts. The goal here is really to evolve this analysis from just a good summary of facts into a powerful, predictive argument.
So the focus should be on the fragility of that revenue guidance versus the cash burn?
Yes, and unifying the technical dip with the skepticism that's still swirling around this RWA pivot. Investors need to know which narrative, skepticism, or validation is winning the battle for DLVT right now.
Excellent work assembling the facts for this piece. We invite you to make these structural and quantitative adjustments and send your updated analysis back to us for another critique.
We really look forward to seeing how you strengthen this compelling narrative and move the argument from just description to real prediction.